Okay, next presentation's from Boss Resources, the Managing Director and CEO, Duncan Craib. Duncan is Managing Director and CEO of Boss Resources, the developer of the Honeymoon Uranium project in South Australia. He's a chartered accountant by profession with vast experience in the mining industry, having focused the last 13 years in the uranium industry with senior roles held in Australia, Namibia, United Kingdom and China. Prior to Boss, Duncan was the CFO of Kalahari Minerals and its 43% interest in Extract Resources, which was the subject of a corporate transaction in 2012 valued at US $2.2 billion for its majority shareholding in the world-class Husab uranium mine in Namibia. Post-transaction, Duncan relocated his family to Namibia to serve as finance director for Husab's $2.5 billion development and construction. Husab was commissioned in 2016, one of the largest mining and processing uranium projects in the world. Shortly thereafter, Duncan and his family returned home to Perth to join Boss Resources. Please welcome Duncan.
Thank you. Jeremy, thank you for the kind introduction. Yeah, upon commissioning the Husab deposit in December 16, I did return back to Perth, and was because I was offered a job with Boss Resources. And you know, it's a simple story, and I'm going to break it down into 3 segments for you to try and explain why the foundations of success reside with this company. And having dedicated my career to the mining and uranium industry, we've had quite a bit of success with that. But basically, there's signals in the uranium market right now that are pointing to a new bull market industry. Plus, you've got the Honeymoon Uranium project in South Australia. It's destined to be Australia's next uranium producer, if not worldwide. And thirdly, the compelling economic and investment thesis around that Honeymoon project. So I'm going to walk you through these 3 sectors as we go through the presentation. To start with the bull market fundamentals, what we're seeing is optimal timing in the market, rising demand, tightening of supply, and the normal barriers to entry. Looking at optimal timing, this graph in front of you is a standard one in most uranium producer presentations. It shows the spot price, but what you can see there is how perception and event-driven this spot price is. Pre-Fukushima, prior to 2011, the uranium price was running very strong. Post-Fukushima, it's dropped off and it's been in the doldrums largely since then. But as a result, low prices, what we've found is that a lot of producers who had legacy contracts struck pre-2011 are struggling now in the current market to keep up with production. So the likes of the giants in our industry, Cameco, have switched off their McArthur River mine, which accounts for a quarter of the world's production, into care and maintenance and then shut down. You're seeing new entrants such as Yellowcake PLC, which are buying spot physical material on market, waiting for this next bull run to rise. Basically, history proves that uranium spot market has got strong fundamentals to rise. 75% of any uranium producer worldwide requires 60 US per pound or higher. Boss Resources, our mine in South Australia, has an all-in sustaining cost life of mine sub 24 US per pound, and we're looking to further reduce that. The market is rebalancing at an accelerated rate. What we see in demand is the fastest nuclear power growth in the past 25 years. Uranium production is in deficit to demand, and why I'm showing this graph is it just shows, because of that low uranium price over the past 7-8 years, there's an enormous amount of uncontracted demand out there where utilities have not entered into offtake agreements to secure that long-term supply. And the reason why is because they've been buying and trading at spot market all these low prices. As well, on counter that, producers have been unwilling to sign into contracts because we're not willing to accept a low price. But that is beginning to change. And remember, production does not respond quickly to price. The Husab project that I helped get into production with the team took 8 years, and we had the full Chinese government support in Namibia. Uranium's difficult, it's geopolitically sensitive. You need all your permitting, you need to raise the finance, and it's difficult processing. The bull market fundamentals in terms of demand, 450 nuclear power plants worldwide, a quarter of those are within the US, which accounts for 20% of the United States energy mix. That is a target market for us. The other target market we have, of course, is China, which is rapidly growing. China's set to increase its nuclear power plant capacity. It's meant to triple that by 2031. India to grow 21 nuclear reactors by 2031. There's this enormous growth worldwide. Nuclear itself accounts for 11% of the world energy mix. It's represented within 28 countries, Eastern, Western, United States. Massive build going on, 11 reactors to be commissioned this year, 13 this year, 13 next year, 111 reactors proposed. Just on China's growth in nuclear power alone requires a new MacArthur River similar to what Cameco closed down last year. When we look at the tightening of supply, it's fascinating. The secondary supply, the inventory levels are rapidly declining. The market's in deficit, that secondary supply is disappearing, and the new prospective developments, those producers that want to come into production, and we know the timeline takes significant time, are going to be dwarfed by the gap. What I experienced in the last bull run is suddenly prices can rise quite dramatically and, in one word, go ballistic. I spent some time recently with Rick Rule, who's a supporter. Rick had a portfolio of 6 projects in the last bull run. His worst performing asset gave a 17-fold return. When we look at barriers to production, and this is probably my favourite slide in conjunction with the Honeymoon project, is because of the low prices, no new production can be built economically at the current prices. There's a lack of funding for new exploration, so there's a real lack of new grassfield, greenfield exploration. And the permitting requirements. It's a geophysically, politically sensitive product, and it's becoming increasingly difficult to get through the red tape and barriers of bringing a project into production. So having looked at the macro, we now concentrate on the Honeymoon project itself. There are 4 key fundamental reasons why I think this is the pillars of a really successful company. It's in the premier jurisdiction for uranium mining in Australia, being in South Australia, significant resources and exploration upside. It's got $170 million spent on the existing plant, which is who we acquired it off the previous operators, Uranium One. And the technical advancement that we've made over the past 3 to 4 years has been nothing short of amazing. When I look at South Australia, 3 of the 4 fully permitted uranium producers in Australia reside in South Australia. It has Olympic Dam, hence both houses of parliament, both sides of parliament's politics support uranium in South Australia. It's got the Beverley operation, which operates a similar in situ recovery process as what we do. The Port of Adelaide has exported incident-free uranium for the past 30 years, ideally suited for the seaboards of the US, for China, for India. First world mining jurisdictions attract that first world talent and investment. But most importantly, utilities around the world want to diversify their supply risk. They don't want to just be tied up to one particular country or company. But here we are, first world mining practices, low geopolitically risk. We're being sought after and in discussions right now with US utilities. If I look at the project itself, the dark yellow areas of the Paleo Channel that hosts uranium, when we acquired the project from Uranium One, over 5,000 drill holes, which were subject to Southern Cross prior to Uranium One. Prior to that, you had Rio Tinto. We've consolidated 5,000 drill holes in 12 different geological databases and 2-dimensional modelling into one database of 3-dimensional modelling. The stars on the Paleo Channel represent the passive seismic areas that we're currently exploring on. We're not wasting shareholders' money in the current market drilling expensive holes, but we are doing passive seismic work, which is highly effective and non-invasive. We have one of the highest grades on the ASX, 620 ppm. Our JORC resource, 71.6, is very commendable, with, on the mining licence itself, 34 million pounds of JORC resource. Shallow mineralisation around, on average, 100 metres in depth. That's very suitable for in situ recovery. And the mine licence there, we're situated about 65 kilometres northwest of Broken Hill, so we're close to within established infrastructure. Ladies and gentlemen, that picture there represents the existing mine, of which our predecessors, Uranium One, spent over $170 million on that with Japanese partner Mitsui. It's got a production plant, power access, airstrip and roads. The camp can house 100 people, though with the redevelopment, I think we can narrow that employee workforce down to 75 with water supply. In terms of the differences that we're making, the areas shaded in grey highlight those that are currently in existence within the plant. What we're doing is introducing a concept called ion exchange. Now, ion exchange accounts for over 50% of the world's production in uranium. We have been working with ANSTO, Australian Nuclear Science Technology Organisation, plus the Inception Group in Adelaide, introducing ion exchange, which is based upon a resin that we identified 3 years ago. Ion exchange and this resin and in situ recovery account for 50% of the world's supply of uranium. It's predominantly moved in Kazakhstan, and by using ion exchange, we're able to lower the all-in sustaining cost to put us into the lowest quartile of producers worldwide. When we look at the technical advancements made since acquiring the asset in December 15, we did the pre-feasibility study in May 17, announced that to the ASX, showing that we can be low capex, low all-in sustaining cost producer based upon ion exchange and the use of resin. We also proved that we could increase the tenor of uranium being leached from the in situ well fields. We then, immediately upon that, we then did a 5-month field leach trial to independently verify that we could actually run a well field, proving the use of ion exchange, proving the use that we could increase the tenor of uranium being leached. It was an outstanding success. But having done field leach trials before, I introduced a chap called Dr. Dennis Stover, one of the United States' top ISR experts, to independently validate our project, and we got a big thumbs up from him. Post that, we completed an infill and resource definition study just to prove up the measured and resources to 71.6 million pounds, of which 34 million pounds resides on the mine licence. Recently, last month, we appointed GR Engineering, who were involved in the scoping study, to the pre-feasibility study, and now they're going to help us complete the definitive feasibility study due for completion mid-November. Around the time of announcing GR Engineering's appointment, I also announced that we've brought on a gentleman, Bryn Jones, who will start mid-September. Bryn spent his whole career within the uranium cycle industry. He also worked on our nearest operation, Beverley Heathgate, and is very experienced in the actual operation of a uranium production mine. Now, pulling all that together into why it's such a compelling investment, we have excellent economics, fully permitted, experienced team. From an economics perspective, the in situ recovery accounts for those areas that you can see in orange blocks. It's the cheapest form of mining. It's not open pit. There's no yellow fleet. There's a very largely reduced number of sort of operators. And highlighting once again, our all-in sustaining costs, lowest cost quartile, sub 24 US per pound. If we're able to go 100% on ion exchange, I believe we can get that further to almost sub 21 US per pound. The proposed stage development approach, when we press the button going back into production, we will refurbish the existing production plant, and then within 9 months that can be brought back into production. In an additional 15 months, the ion exchange process will be built, and thereupon we can increase our production up to 3.2 million pounds. The reason why I've put 3.2 is our export permit is currently for 3.3 million pounds, but we are able to also change that. But there you can see the economic factors that bode so well. The capex required for stage 1 and 2 combined, 68 million US, or equivalent of 100 million Australian, is one of the lowest capex projects in uranium worldwide. The all-in sustaining cost upon achieving 2 million pounds production is that sub 21 US per pound. We're fully permitted, all our native title agreements are in place, and I recently renewed our export permit for an additional 5 to 10 years, approved by the federal government, because we are in compliance with all our regulations. Experienced team, Mark Honan, the chairman, myself, Sashi Davies is our strategic marketing lady. She's one of the top 5 traders in the world. She used to represent Rio Tinto, marketing its uranium, then with Extract Resources, more recently with China General Nuclear. But that team knows how to pull a trigger. We've essentially, we've developed, we've produced, we've exported uranium. We've got a proven history, and of all the teams on the ASX, we represent one of the 3 teams that have done it before and can do it again. Joining me on the board, I've mentioned Mark, myself, Bryn Jones, the founding directors, Evan Cranston, Peter Williams. We've got an institutional shareholding base to be envious of for a market cap sub 100 Australian. Paradise owns 10%, Tribeca 10%. We've got a number of other Australian-based institutions below the substantial holding. International attraction, the L2 fund is the Brazilian dedicated uranium fund. Sachem Cove, Segra, the two United States top uranium funds, both buying into our stock. Research coverage, predominantly with three broking houses and the senior management. Sashi Davies, who I mentioned as the strategic, Keith Bowes and Asha Rao, who's currently on site. She's a 10-year focused uranium exploration geologist. Share price market cap, really just to show we've got $10 million in the bank at the moment, plenty to last us for the following year. Enterprise value of 80 million, market cap around 90. Our share price is hovering around 6 cents. We have first mover advantage, and to sum up the presentation, signals in the market, macro market, are pointing to being on the cusp of the next bull run. Honeymoon project, we're destined to be Australia's next uranium project. We have support with state government, federal government, and all leading stakeholders. We are a leading, low-cost, low-capex, market-ready producer. We're located in stand 115. I'll be there for the duration of the conference, and should you have any questions or wish to discuss any areas, I'd be happy to take that. Thank you.
Okay, just time for a couple of quick questions. Anyone? Okay, well, if there's